Hi, welcome to Finance Decoded. In this video, we will continue with non-DCF investment appraisal techniques. Namely, this video is a continuation of the one about accounting rates of return and return on capital employed. In this video, we're going to focus on another measure, which is called the payback period. Okay, if we now recall the project that we discussed when explaining the return on capital employed, in the very last part of the video, I showed you two projects, okay? And you can see them in the screen right now. The first project is the one that we analyzed, and the one for which we calculated the return on capital employed, which was 15.37. As you can see, the project requires initial investment of 130,000 euros right now, and 5 years from now, assets purchased within this project are going to have a scrap value of 20. Okay, and the return on capital employed was calculated based on the expected profits made on this project, which are 0, 6, 13, 38, and 16,000 in years from 1 to 16. Okay, we can compare this project with another investment, which has the same initial investment, also 170, has the same scrap value also after 5 years. Okay, so the lifespan of the project is identical, but the numbers relating to the expected returns measured as profits are completely different. Okay, in this case, they amount to 0, 0, 0, and 0 in years from 1 to 4, and there is 73 in year 5. Okay, it's not difficult to notice that actually the total profit, after ignoring the time, the time value of money, the total profit of both projects is the same. Okay, it's 73. When you add expected profits in project A to each other, you get 73. Okay, so it's not a surprise that the return on capital employed on two projects is identical. Okay, but the projects are not identical, obviously. Okay, and I'm pretty sure that if I asked any of you which one would you prefer, you would probably point project A, simply because things are happening quicker here. Specifically, the returns are achieved earlier than in the case of project B. Okay, so as you already know, the return on capital employed and other accounting rates of return, they do not address such issues as when things are happening. Okay, so what we can do is we can compare these two projects using the payback period. Okay, see when the initial investment is actually paid back in both cases. Okay, so let's define payback period first. Okay, the definition is very simple. Okay, payback period is nothing else than just the number of periods after which the initial investment is repaid. Okay, so if it's measured in periods, you can present it differently. You can show it in years, you can show it in months, you can even show it in days. Okay, but of course, in the context of your ACCA exam, most likely you will be required to calculate it in years. Okay, and now if we look again at the numbers of the two projects, there's one absolutely important thing that needs to be mentioned. Okay, you cannot simply look at the profits in order to calculate the payback period. Why? Well, because profits are accounting numbers and you cannot compare them directly with a cash flow. Okay, the initial investment, the repayment of which you want to measure with the payback period is a cash flow. Okay, this 170 is actual cash or cash equivalent that needs to be expended when the project is started. Okay, and the numbers that relate to profits, they include some non-cash amounts. Okay, in particular, they include depreciation. Okay, so before you start calculating the payback period, make sure that you are comparing oranges with oranges and apples with apples. Okay, here initial investment is a cash flow. Okay, and apple profits are of different nature. Okay, they're oranges. You need to, reconcile them. Okay, make them comparable to actually calculate the payback period. Okay, so what needs to be done is you need to take those profits and convert them into cash flows. Okay, so add back all the costs that were deducted for the profits to be calculated. In particular, it's going to be depreciation. Okay, and hypothetically, in other more complex cases, you might also consider deducting profits that were included in the profit calculation, which do not relate to cash. Okay, so for both projects, it's going to be fairly easy to convert those profits into cash flows, because what needs to be done is, just the depreciation needs to be added. Depreciation is the same in both cases. Okay, you should be familiar with the numbers. You know that the depreciation in both cases equals to 30,000 euros per year. Okay, and that's something that needs to be done. Okay, so here we've got profits. Okay, I'm adding depreciation, and I can calculate the project operating cash flow. Okay, so for project A, in year 1, the operating cash flow is going to be 0 plus the depreciation of 30, which is 30,000. Okay, in year 2, it's going to be 36. Okay, 43 in year 3, 68 in year 4, and finally 16 plus 30, 46 in year 5. Okay, then I'm going to do the same with project B. Okay, with project B, it's much easier. Okay, because since the profits are 0 in years from 1 to 4, okay, the cash flow needed to be produced in those projects for the profit to be 0 needs to be equal to the depreciation. Okay, so it's 30, 30, 30. In the last year, it's 30 plus 74, plus 73, which is 100 and 103. Again, such cash flows can now be compared with the initial investments. Okay, good. So how can we calculate the payback period? Okay, the easiest way is to look at the cumulative cash return on the project and see when on the timeline this accumulated cash return exceeds the initial investment, which is 170. Okay, so for project A, we can show those cash flows on the timeline. Okay, so here I have the project lifetime of 5 years. Okay, and the cash flows are the following. Okay, in moment 0, okay, or in the beginning of year 1, I need an initial investment of 170. Okay, and then I'm going to insert the cash flows of 30, 36, 43, and so on. Okay, so it's 30, 36, 43, 68, and 46. And an important note that I need to make here. Okay, there's one more cash flow that you should also take into account, which is part of the project's cash flows. Okay, what I'm talking about is the scrap value of 20. Okay, it's a cash return on the project. More specifically, it's part of the initial investment that is expected to come back to the investor when the assets are sold at the project end. Okay, so in addition to this, I'm going to add the 20. Okay, and now how will I calculate the payback period? Well, I'm going to start accumulating the cash flows for year 1, for the first 2 years, first 3 years, and so on. See when it exceeds 170, or when the total cash flow of the project, including the investment of 170, exceeds 0. Okay, so I'm going to put here the cumulative cash flow on the project. Of course, at inception, after investing 170, the cumulative cash flow is 170. Then after 1 year, the cash flow goes the cash flow goes up by 30. Okay, by this amount. Okay, so the cumulative cash flow goes up from minus 170 to minus 140. Okay, then minus 140 and 36. Okay, and we go to minus 104. After adding 43, we go to minus 61. Then if we add 68, okay, we get plus 7. Okay, so we see that here actually, somewhere between year 3 and year 4, okay, the negative total cash flow becomes positive. Okay, so what can we say about this project is that the payback period is somewhere between the 3rd and the 4th year. Okay, it's more than 3 years, but less than 4 years. Okay, because after 4 years we already have a plus here. Okay, so can we get any better estimates than just saying that it's somewhere between year 3 and year 4? Well, we can if we make a certain assumption. Okay, so the assumption that we can make here is simply assuming that there is no seasonality in how the cash flows are generated in this investment project, and just assuming that they accumulate on a straight line, okay, in a linear basis within every year. Okay, if this is the case, okay, we can say that we can calculate a theoretical portion of year 4 that is needed to generate the the missing 61,000. Okay, how can we calculate it? Well, in year 4, we need to produce 61 in order to achieve 0 here. Okay, and the total cash flow of year 4 is 68. Okay, so this fraction gives us, the portion of the year, the fraction of the year that is needed to produce enough cash flows to get this payback period. Okay, of course we can multiply this by 12 to get a number which is expressed in months. Okay, so of course it's a vast portion of the year. Okay, so like 10 or 11 months to calculate it exactly. We're going to need a calculator. Okay, so I'm taking 61 dividing by 68, and as you can see, roughly 90% of the year is needed. Okay, so it's slightly less than 4 years, this payback period. Okay, multiplying this by 12 months, I get something like 10.8 months. Okay, so roughly speaking, 11 months. Okay, so I can write something like this. I can write that the payback period, or PP as it is very often abbreviated, is going to amount to 3 years and 11 months. Okay, 3 years and 11 months. I can do the same calculation of payback period for the second project. Okay, so let's see how it differs from the one for which we just calculated it. Okay, so on a timeline, I'm showing when the cash flows are expected to appear. Okay, and the cash flows are the following: minus 70 at inception, then 30, 30, 30, 30, 103, and the scrap value of 20. Okay, so just like in the case of the first project, I'm just going to calculate the cumulative cash flow. Okay, so it's going to be 140 negative after year 1, adding 30, I get 110 negative after year 2, minus 80 after year 3, minus 50 after year 4, okay, and plus 103 after year 4. Okay, so quite clearly the payback period of project B is longer than the one of project A. For project A, the payback period was somewhere here. Okay, this is project A. Okay, slightly less than 4 years. Now we see that for the second project, the payback period is coming after year 4. It is obvious that the project that will be preferred by investors in this case is the project that has the shorter payback period. Okay, why is that? Well, there are two reasons why payback period is taken into account, or actually two reasons why investors prefer cash returns to appear rather early than late. Okay, and the first reason is risk. Okay, risk is of course one of the crucial topics in investment appraisal, and it deserves a series of other videos along with the description of methods and tools that companies use in order to inform decision makers about riskiness of projects. But generally speaking, when we think about the risk, okay, risk or uncertainty to be more specific, in the context of time, it is typically believed that the magnitude of potential changes stemming from risk, stemming from uncertainty, is the greater the more we move along the timeline. Okay, so the longer the project, the more things can happen. Okay, so clearly from this perspective, the shorter the payback period, the lower the risk of the project. Okay, the second reason is liquidity. Okay, using payback period focuses on liquidity of the investor. Okay, liquidity is the ability of a company to pay back its liabilities, its obligations on time. So of course, the shorter the payback period, the earlier the money returns, the cash returns will reach the company, the more the company will be in position to service its debts and repay its obligations. Okay. Now, finally, it is the time to discuss drawbacks of payback period. Okay, payback period is not a perfect measure. Okay, so let's look at those drawbacks. Okay, so the first drawback is actually stemming from the fact that payback period does not really take into account all cash flows of an investment project. Okay, it stops kind of on the very moment when the initial investment is repaid. Okay, so in the case of project A, which you see in the screen, okay, we only take into account the cash flows that are expected to be received before year 3 and 11 months. Okay, cash flows coming after that. Okay, in this case, it's this cash flow or this cash return of 48 and the scrub value are not really taken into account. Okay, so because of that, the payback period cannot be considered a comprehensive and the only method that can be used by a company to assess financial attractiveness of the project. It simply doesn't give the answer to a question if a project is worthwhile or not. Okay, some other analysis is needed. Okay, and the second drawback stems from the fact that, in fact, the way that the payback period takes into account the changing time, or the phenomenon of the time value of money, is very selective and not sufficient. Okay, what I mean by that is that when calculating the payback period, what we do is just add cash flows coming from year 1 or expected in year 1, in year 2, year 3, and year 4 without discounting them, without really taking into consideration the fact that a cash flow after year 1 is something else than the cash flow after year 2 because of the time value of money. Okay, in fact, looking at the project, which you can see in the screen, we could take any of the numbers, take like this, return of 30 after year 1 and swap it on the timeline with the return of 36 in year 2, and it would not affect the payback period. Okay, so in fact, payback period doesn't really include the time value of money in full. In the next videos, you will learn about more comprehensive and more adequate methods of investment appraisal, the ones that take into account the time value of money. These are the discounted cash flow techniques, namely net present value and internal rates of return, which are the preferred tools used by companies to assess investment projects.